Well, hello, this is Paul Martin with Investor Connect. Today we're here with Matthew Merle. Matthew, thank you for joining us.
Very happy to be here and to be speaking to your listeners.
Well, you're quite an experienced investor. Can you tell us a little bit about yourself first and then a little bit about how you got into angel investing?
Yes, Lish, I grew up in the UK, as did my wife, and we came here with a management consulting firm to attend business school. And for the first 20 or so years of our careers, we were management consulting partners of large firms. In the run-up to the dot-com boom, we started doing a little bit of angel investing, probably about 20 years ago now, and really got bitten by the bug and found it really fascinating to be backing teams of entrepreneurs and being involved in new innovations and new opportunities. And so we've kept that up for the last 20 years. And today I help run the world's largest angel group, Keiretsu. I help administer the funds, Keiretsu Capital, and my wife and I have our own family office, Fifth Era, where we make direct investments and support entrepreneurs.
Well, that's great. And so you've done a lot of research in the area of angel returns and venture capital returns, and that's always a big question with angel investors is what to expect and how does it compare to returns in other sectors or investment classes? What can you tell us there?
Yes, thanks for asking that, and it is an important question. As an early-stage technology investor, there's a lot of optimism and a lot of positivism that sort of surrounds the space, but I think a lot of people may not understand the dynamics of investing and getting a good return. So just to really keep this short, the good news is the returns in early-stage technology are really phenomenally positive and attractive. They're actually amongst the highest returning asset classes of any in the world. And so the venture capitalists over the long term average somewhere in the high 20s or low 30s IRR from their early stage investments. And the angels are very similar. Some of the studies put the angel return in the mid 25%, 26% IRR. Most recently, Harvard and MIT have suggested the return is actually higher than that of the VCs. But that return comes in a very specific way. If we get a high degree of failure, so typically 50 or 60% of the companies return less than the money we give them. And at the other extreme, 10% or so of the companies get us a 5x or better. So we have a dramatically positive multiple on our investment. And in the middle, you have 30 or so percent of the companies between 1x and 5x. So it's a hit-driven business. And as with all hit-driven businesses, that means you need to be very diversified. You need to make a lot of investments, 20, 30, 40 investments to have 90% or more probability of getting the expected return. So that's basically the story. Angels do exceptionally well so long as they're highly diversified and so long as they follow the best practices of angel investing.
Why are angel returns higher than VC returns? What's different between the two that accounts for that return difference?
Yeah, very good question. Well, so the overall venture capital return sort of hides an important point, and it is that averages lie. The venture capital firms of America invest in early stage technology, but over the last decade or so, they've raised larger and larger funds. And most of them now participate in mid-stage and even late-stage investing, including pre-IPO or expansion capital. The returns fall the closer you get to the public markets. And so when you look at the long-term returns of the venture capital funds, they may get something like 30% IRR for their early-stage investing. They typically get mid to low teens for mid-stage, and their late-stage investing is getting only slightly better return than the public market long-term return. So their average return is the average of all of those different stages. But when you look at their weighted capital return, they're actually putting much more of their capital into late stage than they are in early stage. And just to give you some numbers to hang your hat on around that, the entire venture capital community of America, over 1,000 firms, only backed about 7,500 companies in 2016, of which only about 2,000 of them were early-stage first-round deals. Everything else was follow-on capital. And that accounted for perhaps $8 billion or so of their $70 billion of investment. But then one company, Uber, just to give you an example, took $2 or $3 billion that year. So their late-stage investing is dramatically larger in terms of capital deployed than their early-stage investing. And so their average return is being pulled down by the fact that they look more like private equity investors, what we in the past would have called private equity investors, than venture capitalists. Most of the really top-tier firms put relatively little of their capital in starting new businesses.
So what impact does the VC management fees take on the returns to investors, as far as they usually take a 2% and 20% carry, and that, of course, reduces the return? Angels typically don't take those fees or that type of fee, but how much of the difference in returns are attributed to the fees?
Yes, great question. And you are correct. The historical model of venture capital was a 2 and 20 model, 2% management fee, 20% carry. For early stage investing, the funds may even charge more. They may be 2.5% or 3% management fee and 25% carry, because obviously they're making very small bets and their overhead is quite substantial on smaller funds. We'll come back to whether or not the fees are justified, but the impact of the fees, I've seen analysis that suggests that it accounts over the lifetime of the fund for a typical VC as much as 10 points between the gross and the net. So if the fund averaged, let's say, 25% net IRR, if there were no fees, it might have made 35% gross IRR. But of course, there are fees. Now, the averages always lie, Paul, and so there's an enormous distribution within the venture capital community of returns. So the very best firms have returns much higher than the numbers we're talking about, which are all averages. But conversely, at least half of the venture capitalists in America destroy economic value. In other words, their return is less than the risk-adjusted weight of capital. And it is, to a large extent, the fee structure that pulls them underwater.
Well, many VC funds are based on a 10-year model. So in the first 3 years, you're deploying capital. Next 3, you're maintaining, and last 3, you're hopefully exiting some of them. And so there's an arbitrary time frame that they have to operate in, while most angels don't have those same limitations. There may be the same expectation of getting in and out for a certain amount, but there's no fund that has to be met certain criteria. How much of the return is impacted by that arbitrary 10-year fund life cycle?
Right. Well, that's a very complicated question, and I'll try and unpack it a bit. The first thing I'd say is I'm a big fan of the best venture capital firms, so I don't want anyone to misunderstand that point. I think the best venture capital firms add enormous value, and I think that they really help their companies succeed. And it does cost time and money to help companies, and that's why they charge a fee. And so they get wealthy, but if they've done a good job, their companies become very successful. And you look at a Sequoia as an example, and I think something like 30 of America's 250 unicorns are Sequoia-backed companies. So there's clearly a record there, and they work very hard to help their companies succeed. Now, it is true that the typical 2 and 20 fund model does include a 10-year lifespan, as you mentioned, with 1 or 2 or 3 one-year extensions possible. So the way that really impacts the behavior of the venture capitalist is in the out years. In the first years, they're making investments. Of course, they want to try and help the companies get to quick exits, but they actually would prefer large exits. And so a lot of their effort is trying to help the companies become very large and very successful. But on the margin, quick exits drive the returns a little bit better, especially if there's a recycling of capital. And some funds do allow them to recycle capital maybe once in the lifetime of the fund. But at the other end of the fund's life, when you get close to that final period, they need to show returns. And so you will sometimes see companies being driven to an exit because there is a need for the venture capitalists to see a return. Sometimes there'll be trading that happens between funds. That's much more prevalent in private equity than venture capital. But that would be, I'm venture capital A, I own a position in the company, my fund's coming to the end of its life. I actually sell that stake to venture capital fund B at probably a preferential price, but it allows me to see an exit. and demonstrate some liquidity, the company may still have a lot of upside in it. So you do see activity and behaviors like that, but I think it's not the norm, and I think it is more prevalent in private equity funds. When it comes to VCs, you typically, within 10 years, have a pretty good sense of if a company is going to make it or not. And I'd say most of the bad companies will have gone under, and most of the good companies will have exited. And you'll only typically have, if they've made 30 investments, they might have 3 or 5 that are still alive and in the portfolio at the 12-year mark.
Well, we've been talking about angel returns and venture capital returns, but the new kid on the block, so to speak, is now being driven by blockchain technology. And it seems like that's a very disruptive technology that's changing the investment world as well. What do you see going on with blockchain these days?
Okay, thanks for asking. And I want to paint a picture a little bit here, because I think that again, this is something we need to sort of clarify. So there is blockchain, the technology, which is itself an emerging technology, just as others like artificial intelligence or the Internet of Things, sensors or life sciences, CRISPR, Cas9, things like this. These are emerging technologies, and blockchain is an emerging technology, a very substantial one that has a lot of excitement attached to it. Secondly, there are cryptocurrencies, which are, if you will, virtual currencies or assets that are based upon blockchain technology and allow certain functionality. And they are essentially software, but they allow certain functionality to exist, and they can be used as stores of assets or currencies, amongst other things. And then we have the notion of the ICO. And the initial coin offering, or the ICO, is a funding technique, and it does typically require the existence of a token, and that token is what's being offered as an investment opportunity. But that is clearly a funding mechanism. So I make those distinctions because traditional venture capitalists and angels can invest in blockchain technology companies just as they always would and ask for equity positions. Meanwhile, cryptocurrencies are available for anyone in the world nowadays to open a wallet and buy some if they wish. And obviously the SEC and other regulatory bodies are trying to think through who should be able to buy them and how and under what circumstances. But then the ICO is a very specific thing. And right now, they come in also in various shapes and sizes. There are private ICOs, the public ICOs. There are ICOs that are only taking money from accredited investors, and others that are opening themselves up to non-accredited. There are ICOs that raising most of their money in a private placement, a pre-sale private placement, and there are others that are actually offering, more of a public offering. So I wanted to give that background, Hall, just because I think each one of these things is very important, but they're very different. And I think all three of them are going to be with us for the long term, though they may be moving in different directions from where we see them today.
Great. Well, we saw that angel returns were overtaking venture capital returns. Do you foresee ICO returns overtaking angel returns as the funding goes, so to speak, down and out to a broader group of people and the wisdom of the crowds takes over? Right.
So obviously that's the big question, isn't it? What will the future returns look like? And at one level, no one knows. On the other hand, past is prologue. So to answer that question, I look at the past and I try and remember what happened and try and figure out what the smart strategies were. And I look particularly at the dot-com boom because I lived through it here in Silicon Valley, and I've been spending a lot of time thinking about what were people doing in 95 and 98 and who were the winners and who were the losers and which strategies paid down, which didn't. And my feeling is it's feeling somewhat similar. So, when we first, we created the Internet Protocol, TCP/IP, very few people really understood what it was or how to use it or what applications to put it to. And there were all these crazy ideas. You can call them white papers now, but back then they were business plans. And, there was pets.com and there was eToys and there was this, that, and the other. And there was a proliferation of them, vast numbers, and they were getting backed very easily. They were raising capital. Their valuations seemed outrageously high at the time. And, of course, most of the businesses failed. And, as angel investors, we would expect nothing less. In innovation, the failure rate is always high. But back in the dot-com boom, people were putting big values on ideas, and oftentimes the teams weren't able to build the company. So it was a hit-driven business, and there were some smart strategies, and diversification was one. Being an insider was another, and investing with the best investors was another. So there was a bunch of different strategies and more. Now I look at the blockchain phenomena and the ICO phenomena that we're living through right now, and I feel exactly the same way. There's too many white papers. Many of them are being created by teams that probably don't know how to build a business. And even if they have a big idea, they don't necessarily know how to turn it into a global big idea and a big business. There's a lot of competing ideas. There's 5 and 10 versions of the same white paper. There's obviously bad actors who are really just trying to raise the money and run for the exit as soon as they can. And so I'm feeling very past this prologue. I think that over the next year or two, we'll see a shakeout, but we'll see real businesses surfacing that will change the world. And that was also another internet phenomena. The businesses created in the dot-com period are still with us, and some of them have changed the world, but most of them fell along the way. And I think that will be true with these ICOs and new blockchain technology companies. So the question is, can you find the smart strategies to invest into this space?
Well, it seems like the principles of startup funding never change, but just who does it and what technology we're using is what comes in and out every decade. And my experience is the top 10% of the companies are good returns, next 15% are some returns, and the bottom 75% are no returns. And that seemed to apply to the VC and the angels, and I suspect it will apply to the ICOs and the blockchain. Your challenge is finding the top 10%, of course.
Yes. I mean, obviously, if you could consistently find the top 10%, then you would be the world's best investor. So even the very best venture capitalists in the world have high failure rates. So most of us, you have a diversified strategy, you have a portfolio strategy, you know that failure is going to come. And so what you're actually trying to do, Paul, is not so much pick the top 10%. It's more that you're trying to put yourself in the right places with the right teams, so that you raise the probability that your portfolio will have a bit more success than the averages and a bit less failure than the averages, and maybe 1 or 2 big exits. And when you weight all of that together, you end up with an exceptionally high return. And so I do think it's sort of there's a lot of detail, attention to detail, and all the traditional questions is important. I think you did, by the way, say something very important a moment ago, which was the fundamentals of investing still apply. And I believe that. In the dot-com boom, I would sit in rooms, and I'd been in the McKinsey corporate finance and valuation practice as my first job out of university. And so I thought I knew how you value things, and I didn't understand eyeball-based valuation at all. I didn't understand it. I couldn't see how it could work. And of course, it made no sense in retrospect. People paid a ton for eyeballs, and most of them didn't drive any real demonstrable value to those eyeballs and didn't make money. And I think that's going on right now too. So people are talking a lot about building communities and getting large followings, and that doesn't mean that you're going to have a valuable product that people are going to pay a lot for over time. And so I agree with your point. The fundamental principles of building a business, being an entrepreneur and investing still apply, I think, in this ICO blockchain world.
Well, that's great. Yeah, one final question for you is, I see some VCs take their money and they spread it across a very large number of startups for the early stage, and when the winners come up, they then double down on those, and they just keep following them as they go up. And so it's almost like an index approach. We don't know where the winner is, but we're going to try to give as much coverage as we can. Do you think that's a viable strategy?
So with my day job, which is being with Randy and Nathan and others helping, and all of the chapter presidents helping drive Keiretsu, the angel group, forward, we don't take that strategy. Our broad strategy is to do high-quality due diligence and terms negotiation and company support, one company at a time. And you're trying to make each company and each team that you back succeed as much as possible. So it's not Moneyball. It's really, one company's high amount of time and energy and trying to support them, get the entrepreneurs to a good place, which typically is corporate acquisition rather than a unicorn IPO. I mean, the unicorn IPOs are are just what they say they are. They're ephemeral and very unlikely to happen. So most angels make most of their money by building businesses for other people to buy and run. In the blockchain space, which is a leading-edge fundamental technology that has never been seen before and is very coming now, so to speak, that we're right at the beginning of that wave, then I do think that a strategy of broad diversification probably would make sense. And so to be a bit more specific, what we've been doing is finding ways of getting our money into the best VCs in the space, people like Blockchain Capital Partners, as an example, Bart and Brad and Spencer, who run that firm. And because they'll then go out as insiders to make a portfolio of investments, and they'll basically carry our money with us. And yes, we will pay the, as you said, 2 and 20 or whatever it is, but we think that's a good price to pay. In cryptocurrency, I have the same view, by the way. So I think you can choose to be a Bitcoin maximalist and put all your money in Bitcoin. For my part, I'd prefer to have a diverse strategy into cryptocurrency, and so I'd sooner be in a Polychain or a Metastable or a Pantera ICO fund than to try and make the decisions myself one at a time. And in fact, we've invested in another one called BitBull, which is the first cryptocurrency hedge fund of funds, and we like that type of a strategy because you get much broader coverage of an emerging area of technology, and you don't necessarily have to make every decision yourself.
Well, that's great. Well, I appreciate you taking time to share your insights with us today about angel returns and VC returns, as well as the blockchain technology that's coming up. Please let us know what we can do to help you, and we hope to see you back in another interview for other topics.
Well, I'd love to, and we really appreciate your hard work getting the word out about angel investing, and showing the best practices is beneficial to all of us and the entire community. So I really appreciate your hard work, and thank you for interviewing me.
Thank you so much.